first had to get and maneuver past capital outflow restrictions. In the case of Europe, when we went to the euro in 1990, they eliminated the capital outflow restrictions that existed prior to that. Some countries have not eliminated them. Japan eliminated them quite some time ago. So basically, then you had the other problem, which is most privately managed money in those countries have something called an investment mandate, where they're not permitted to invest the funds outside the country, because if they did so, they would take exchange rate risk. So there was basically for a long time, there was a major wall between the investor returns abroad and the United States. They could run the rates low, but the money was trapped in those countries. They couldn't get to a higher rate country like the United States, either by government-wide capital outflow restrictions or mandates which define what investments a manager can purchase. The bias is to maintain a portfolio in the home country currency, so that when it comes time to pay the benefits in the home currency, you don't take exchange rate risk. So for a long time, we were in a situation where basically the interest rates in the different countries were independent of each other. Each of them were determined by, since World War II anyway, by what in the judgment of the central bankers was an interest rate that was proper for their economic advance. Basically, they wanted an interest rate low enough to stimulate the economy, to generate full employment. That number was different from every country. And basically, each country could run an independent monetary policy, including the United States. So basically, you didn't have to look elsewhere at interest rates elsewhere. You just had to look at the state of your unemployment to determine, as a central bank, what is the appropriate interest rate for that economy. Well, guess what? All that history has just gone out the window. Major change in our framework of thought, major change in understanding what's happening, why are the interest rates going up or down, why are they at this level, and it has major implications for the value of your investment portfolio for all kinds of assets. Basically, what we've had in the last half a dozen years is an over-the-top effort on the part of central banks to stimulate their economies. The leading biggest ones were the ECB, the European Central Bank for Europe. As I said, they moved the rates down to a low number, then zero, then negative. Same thing with Japan. But they still could not stimulate the economy strongly enough. So they kept going lower and lower. At this point, in total, there's 15 trillion of sovereign debt, which is country debt, in yielding negative returns. 15 trillion, that's an awful lot. So basically, they're looking for a home that gives a higher yield. And if you eliminate the capital outflow restrictions, or they're no longer enforced, and what we've had the last year is private capital outflow restrictions by each pension fund is being relaxed. Last week, basically the government Social Security Fund for Japan just relaxed the restrictions on saying they had a regulatory restriction that that the managers can only invest the government Social Security Fund into Japanese assets. Well, they just redefined what was a Japanese asset and included the U.S. So they didn't change the regulation, just the definition, which was the easier way to do it. And so basically, now we have a situation where $15 trillion of negative yielding sovereign debt, which is typically the least risky, because after all, sovereigns can tax you to get the funds to pay the interest due. So you have least risky debt with a negative yield. And if we now eliminate capital outflow restrictions, or they're no longer enforced by countries, the capital can run to where the rate is highest, which had been the United States. So over the last year, the rates, particularly the last 6 months, there has been a gush of buying in our treasury market, bond market. And it's not from the Fed and the newspaper reporters who are still educated in the last 50 years from all the old textbooks. And basically they all think the suspect of the buying power comes from our central bank. Well, it has not been our central bank. It's been the private investors over the rest of the world that owns negative yielding debt that want to sell it and buy U.S. treasuries with higher yielding. Low risk, high yield. And we've had a massive inflow in that respect. Now think of the market pricing as a result of the massive inflow of foreign capital buying U.S. assets. For one, the dollar has appreciated. That's not exactly welcome news for the U.S. It means our trade or exports have hurt. Our trade surplus, our surplus is already in deficit. It became more in a deficit. So basically, in one respect, it helps us because the foreign buying of bonds raises the prices, lowers the yield, but at the cost of a less favorable exchange rate. Our U.S. goods for the rest of the world have become more expensive, and it's showing up in our trade numbers, in our exports. So basically, the capital's coming here. I guess the good news is U.S. private investors' market value of their portfolios in general have risen. It's not just, and here's the interesting thing and most important thing, if the demand in the first instance is for U.S. treasuries, it spreads out to all assets, every asset, because the treasury prices increase, and U.S. managers are looking at this big capital gain, and they have been big capital gains in long-term sovereign bonds in this past year. They start to distribute those gains across other asset classes that have not so benefited. So basically, the purchasing power spreads out to all substitutes. This is a cornerstone of something called price theory. If these assets are competitors with each other, and indeed they are, and one price becomes very high, the buying power spreads to the ones that have not been increased in price and still have higher yields. So basically what we've had is an incredible gush of foreign purchases of U.S. treasuries, which are now trickling over to all other assets. So we now have a situation, and how does this, what's the net on the U.S. economy and the U.S. financial markets? Well, our interest rates are lower, particularly long-term interest rates are lower. It has positive Keynesian type effects on spending. What it will most affect is housing, and actually housing permits are running at about a 10-year high right now. We have a generation, actually two generations of Americans looking for houses, different houses. Both the baby boomers are looking for a housing suitable for being a retiree, and we have the millennials looking for housing suitable to them. So basically, these long-term low interest rates in the U.S. that started with treasuries now are flowing over into the mortgage market and having an effect on demand for housing in the U.S. So we're having a positive economic overflow as a result of this. On the other hand, as the capital from abroad comes in, our currency is more expensive, so we're losing out on trade. So it's a mixed picture in the United States. But it also has another impact, which is very, very important, and that is the higher prices of the treasuries. Those gains made by those investors get spread out to other assets. Basically, it causes other asset prices to rise relative to the income being paid. Now, for example, with stocks, what this means implicitly is that the PE ratio, or the PE, price earnings multiplier, on equities will end up being higher than they would ordinarily. In other words, $1 of earnings, the market will pay a higher price for $1 of earnings from the U.S. corporate sector. And that's what's happening. It's supporting equity prices, even though the economy is listing. We're not going to negative growth yet. We're still positive, and we're at the edge of trying to figure out exactly which way the chips will fall from here. But the point is, the price earning ratios are holding up despite the fact that the economy is not holding up nearly as well. So we're having major changes that are occurring. Foreign inflows, raising the dollar in foreign exchange markets, causing our trade deficit to increase, but at the same time we're getting the typical Keynesian low interest rate positive effects on spending as well as asset pricing across the board. So it's a very mixed picture, a totally different dynamic. Now, where does that leave the Federal Reserve, our central bank, who thinks of themselves as the entity that controls U.S. interest rates? And more than that, our body politic and our body of investors think that, because that has been the case for the last 75 years. The Fed has been king as far as interest rates and as far as market prices of assets. Well, it turns out the gush of foreign buying stimulated by foreign central bank money generation and bond buying there, basically they are controlling our interest rates. The Fed is in a quandary. They don't know what to do. Lower interest rates, raise interest rates. It goes back and forth in the last few months. It turns out they have already lost control of the U.S. interest rates. And what I find most distressing is they don't seem to understand it. What they do doesn't matter anymore. What the buying power that they put into the market is being overwhelmed by the foreign buying power. So basically, the foreign central banks cumulatively across the world are determining U.S. interest rates and U.S. exchange rates. So if I were on the Fed board, I would keep my mouth shut. I wouldn't reveal to the market that you have no control left, or very little control left. And basically, you're taking all the blame and you have nothing to do with creating the situation. The Fed should go back to their old policies of never saying anything in public and try to work behind the scenes and get control back over our interest rates. That would take some kind of capital inflow restrictions, which are possible. So that kind of thing has happened. That might, for the Fed to get back in the driver's seat, they have to eliminate the gush of foreign capital. And that would be a very tough one to argue, but we could do it. We could do it, but basically that would take years to digest. But in the meantime, the foreign central bank is buying and creating higher prices abroad, is gushing over into the U.S. market, creating demand for financial assets, which are now getting spread across the board.